This is one of the most powerful and unique oscillator systems I've come across on TradingView. It combines multiple oscillators into a single weighted analysis. Today I'm showing you how to pair it with a simple trend filter to create a highly effective strategy. Oscillator Workbench chart. Created by LucF, this comprehensive Pine script indicator transforms multiple oscillators into a unified weighted analysis system for market direction assessment. The workbench combines up to 3 oscillators, 2 built-in selections plus 1 external input, into an aggregate weight that influences price-based moving averages, creating oscillator and divergence channels for market state identification. The indicator calculates normalized weights from selected oscillators by measuring their distance from center lines relative to historical extremes. These weights modify a reference moving average to create a weighted version, with the gap between them forming the oscillator channel. The system identifies 4 market states: bull, bear, strong bull, and strong bear conditions, based on price position relative to reference levels and directional momentum of both lines. The divergence detection engine monitors opposing movements between reference and weighted lines, establishing dynamic channels that capture periods of market indecision or momentum shifts. When divergences occur, the indicator creates temporary zones that track subsequent price behavior until breached, providing early signals for potential trend changes. Relative volume weighting adds another dimension by amplifying oscillator influence during high-volume periods, while customizable capping prevents extreme oscillator readings from distorting the visual scale. Strategy applications include trend continuation signals when both channels align in strong states, reversal identification through divergence channel formations, and momentum confirmation through oscillator channel transitions. The workbench supports various trading approaches, from scalping with short period settings to swing trading with longer lookbacks. Now here's the thing about the oscillator workbench. It's incredibly powerful at identifying momentum shifts and market states, but we need something else to complete the picture. We need a reliable way to identify the overall trend direction. The OWC does have its own built-in moving averages with different types you can enable and use to filter the trend, but I'm going to strongly recommend using an EMA ribbon instead. In my opinion, the ribbon eliminates a lot more noise and works much better as dynamic support and resistance compared to any single moving average. I've chosen one that I use in most of my strategies because it's effective and meets our needs perfectly. It's called MA Ribbon R5 by Just Uncle L. This indicator offers a variety of moving averages to choose from, along with color-coded candles and adjustable timeframe settings. There are additional features you can explore on your own, or you can check out my previous videos about this indicator. I'll link a few in the description below where I go into more detail. For our purposes today, we'll focus on the ribbon's color coding: green for uptrends and red for downtrends. Simple and straightforward. The default settings usually work well right out of the box, but you can experiment and maybe you'll find something that suits your setup better. As always, lower settings will work better for scalping and higher settings for swing trading. But very often these indicators are good to go straight from default, so most of the time you simply need to choose your time frame. And before you ask for the best time frame, the best one is the one you're actually trading on, not the one someone tells you is optimal. Make your necessary adjustments, test it, backtest it, forward test it, and find what works for you. Now for the OWC indicator, we'll set the reference line to exponential, which gives us smoother price responses, and will enable the divergence channel for better visibility of market state changes. Here in the divergence channel section, you can choose whether levels are defined using high and low, which will give you a slightly wider range, or open and close, which can get you into trades more often, but can also produce more noise. Since we have the ribbon as a buffer and trend filter, we'll go with the open and close option to capture more opportunities. Here's the most important part. In the bar coloring section, enable the Don't Color Falling Volume Bars option. This is critical because it automatically filters out low volume, weaker signals. You're only seeing the moves that have real volume behind them, and that makes all the difference. Now let's get to our strategy rules, and as straightforward as they might seem, there are a few things to watch for, so stick around. You'd usually want to enter when the price retests the ribbon in the trend direction, meaning we're only looking for longs when the ribbon is green. Price pulls back, gets rejected, and we have a colored candle close above both the ribbon and the channel. When I say colored candle, I mean the one that's displayed when the Oscillator Workbench gives you the signal, not the regular green you might be using on your chart. Yes, it might look sometimes that you're late to the party and the move has already developed, and you could have entered much earlier. But this is actually why this strategy is so powerful. You're not jumping on every trade opportunity. Instead, you wait for all the conditions to align, confirmed by strong volume, which overall can significantly improve your win rate. I'm not going to bore you with all the risk management practical theory. Once you're in the trade, place your stop loss below the most recent swing low and target 2 times risk if you're trading pullbacks. If you're looking for higher risk-reward trades, you might want to consider the break and retest method, which we'll discuss in just a moment. Look, the example I just showed you looks good when it works, which means when price is actually trending. But here's the reality. Most of the time, the market is chopping, not trending. Sometimes we just need to wait for price to break out of that chop. When we enter the trade on that initial break or retest, we can aim for a much higher risk-reward ratio. If you see the price slicing through the ribbon and Oscillator Workbench channels up and down repeatedly, you guessed it, we've entered a range. The best approach here is to start connecting those swing highs and swing lows and wait for the price to break out. I wouldn't recommend entering right on the breakout. Wait for the retest and rejection instead, using the same principles we discussed earlier with the colored candle and volume confirmation. In cases like these, you can aim for 1 to 3 or even higher risk-reward ratios. Just always look to your left on the chart and check if there are any major price levels that the price might bounce off when planning your targets. Check our recent video if you want to see 5 trending TradingView indicators right now.